There are 90,000 Americans who are 81 years old or older and still owe an average of $29,000 each in federal student loan debt. That number was documented by the Consumer Financial Protection Bureau in its official analysis of Social Security offsets and defaulted student loans, citing data provided directly by the Department of Education. 90,000 Americans, over 81 years old, with federal student loan balances averaging $29,000 apiece, and no statute of limitations protecting them from collection, ever. That number is the endpoint of a crisis that begins in what everyone assumed was a temporary financial inconvenience during a working career, and that, through a specific and legally ironclad chain of consequences, ends with a federal agency withholding a portion of every Social Security check a retiree receives for the rest of their life, regardless of how old they are, regardless of how long they have been trying to pay, and regardless of whether the interest accruing on their balance is growing faster than the offset can reduce it, because for many of them, the balance is growing. The GAO, in its definitive analysis of Social Security offsets and defaulted student loans covering fiscal years 2001 through 2015, documented the specific finding that has since only grown more severe. Some older borrowers saw their loan balances increase over time despite the Social Security offset. The government was withholding money from their monthly retirement benefit check. The loan balance was still getting larger. The math of 15% of a modest Social Security benefit against the interest accruing on a multi-thousand-dollar balance at 6 to 8% annually produces exactly that outcome for borrowers whose income-based offset payment is smaller than the monthly interest accrual. This is the story of why student loan debt is no longer just a career problem. It is a retirement destruction mechanism. And in 2026, with 2.6 million student loan borrowers having been transferred to the Department of Education's default resolution group in the first quarter alone, with the number of borrowers over 62 having grown more than 70% since 2017 to reach 2.9 million, and with the Social Security Trust Fund itself on a documented path to fourth quarter 2032 insolvency that will cut benefits by 24 to 28% automatically, the borrowers subject to the offset face a double destruction that no financial planning model built in any decade before 2026 anticipated. Let me build the full mechanism, because understanding it precisely is the difference between knowing this problem exists and understanding exactly why it cannot be solved by ignoring it, by continuing to make minimum payments, or by assuming the temporary pause in collections announced by the Department of Education on January 16, 2026 represents a permanent resolution. Start with the legal architecture, because every element of the crisis flows from 3 specific legal facts that together create a collection mechanism unlike any other form of consumer debt in America. Legal fact 1, federal student loans cannot be discharged in bankruptcy. Every other form of consumer debt documented in this series, credit card balances, auto loans, medical bills, personal loans, can be eliminated through the bankruptcy process. Chapter 7. Filing liquidates available assets and discharges the remaining unsecured debt. The filer emerges with damaged credit, but no legal obligation to pay the discharged debts. Federal student loans carry a specific statutory exception. They cannot be discharged except by proving undue hardship under a standard that federal bankruptcy courts have applied with such rigidity that the Center for Retirement Research and the CFPB both document it as effectively unavailable for most borrowers. A 68-year-old who files Chapter 7 can discharge $30,000 in credit card debt and emerge the following morning still owing $30,000 on their student loan. Legal fact 2, there is no statute of limitations on federal student loan collection. State consumer debt statutes typically limit a creditor's ability to sue for payment to between 3 and 6 years from the last payment or the date of default, depending on the state and the type of debt. The federal government has no such limitation on student loans. The right to collect never expires. A loan taken out in 1987 for a college education attended by someone who is now 75 is collectible today with the same legal authority as a loan taken out last year. The government can activate its collection tools at any time, without going to court, without a new judgment, and without any trigger other than the continued existence of the default. Legal fact 3. The Treasury Offset Program allows the federal government to intercept federal payments to individuals, including Social Security, retirement, and disability benefits, and redirect them toward outstanding federal debts, including defaulted student loans. The offset can be up to 15% of the monthly Social Security benefit, but cannot reduce the payment below $750 per month. The $750 floor was established in the 1990s and has not been adjusted for inflation. $750 in 1996, when the floor was effectively set, had the purchasing power of approximately $1,300 in 2026 terms. The nominal floor is unchanged. The real purchasing power of the floor has fallen by more than 40% over 30 years. Those three legal facts together create a collection mechanism that has no equivalent in the consumer debt landscape. It is permanent, it operates against retirement income, it cannot be eliminated by bankruptcy, it has no expiration, and the floor protecting against the most severe impoverishment has eroded dramatically in real terms since it was established. Apply the four-stage pattern, because the pathway from student loan borrowing to retirement destruction follows a documented sequence that the GAO, CFPB, MIT Age Lab, and Center for Retirement Research have each mapped from different analytical perspectives, and the convergence of their findings reveals how predictable and how preventable the outcome is at each stage. The first stage is the borrowing phase. This is the stage that most analysis focuses on, and that the dominant political debate about student loans centers on. Who borrows? How much? For what purpose? For young borrowers in their 20s, the borrowing phase is the beginning of a career narrative that the loan is supposed to finance. For older Americans, the borrowing phase has taken three distinct forms. The first is the original borrower who took out loans in the 1980s or 1990s for their own education, made payments for years, fell into income-based repayment when income dropped, and has been carrying a balance that grows despite payments because the interest exceeds the monthly payment obligation. The second is the Parent Plus borrower who took out loans in the 2000s or 2010s to finance a child's education with the expectation that the child would take over the payments or that the family income would remain sufficient to service the debt. The third is the late career borrower who returned to school in their 40s or 50s to retrain for a new career after job displacement and finance that education with federal student loans at rates between 5 and 8%. The CFPB documented that the number of student loan borrowers ages 62 and older increased 59% from 1.7 million in 2017 to 2.7 million in 2023. The Newsweek reporting in May 2025 updated that to 2.9 million, a 70+% increase from 2017. The number of borrowers under 62 remained unchanged at 43 million over the same period. Only the over 62 segment grew, and it grew not because older Americans are taking out more loans, but because borrowers who took out loans decades ago are aging into the retirement window while their loans remain outstanding. The second stage is the income-based repayment trap. This is the stage that receives the least attention in the public discussion of student loans, and that produces the most permanent financial damage for older borrowers. Income-based repayment plans, which are available to federal student loan borrowers who demonstrate financial hardship, set monthly payments at a percentage of the borrower's discretionary income. Typically 10 to 15%. For the borrower with a modest income, that percentage produces a monthly payment that is less than the monthly interest accrual on the loan. The difference between what is paid and what is owed accrues to the principal. The balance grows. The borrower makes every required payment according to the plan, and the loan balance is higher at the end of the year than at the beginning. This phenomenon, called negative amortization, is documented by the GAO as the specific mechanism that produced growing loan balances for older borrowers even when they were subject to Social Security offset. The GAO found that for older borrowers subject to offset, more than 1/3 remained in default 5 years after the offset began. Some saw their loan balances increase despite the offset. The monthly offset amount, limited to 15% of the Social Security benefit, was insufficient to overcome the interest accrual. The debt was being collected. The principal was growing. The Center for Retirement Research documented the specific population most trapped in this phase. Older borrowers with credit scores below 720 had median student loan debt amounts more than twice as high in 2019 as in 2003. These are borrowers for whom the income-based repayment mechanism was designed to provide relief, but whose lower incomes produced payment amounts too small to prevent the negative amortization that expanded their balances over 16 years. The third stage is the retirement benefit destruction phase. This is the phase that begins when the borrower reaches Social Security eligibility and their federal student loan remains in default. The Treasury Offset Program activates. The monthly Social Security check is reduced. The typical monthly offset, documented by the GAO, was slightly more than $140 per month. Almost half of the older borrowers subject to offset were at the maximum 15% cap. For a retiree receiving the average Social Security retirement benefit of approximately $1,800 per month in 2026, 15% is $270 per month. After the Medicare Part B premium deduction of $202.90 that is automatically taken from most Social Security checks, the net monthly benefit available for living expenses is approximately $1,327 per month. That is before food, before housing, before utilities, before any other medical expense. $1,327 per month in a country where the average rent for a one-bedroom apartment in most metropolitan areas exceeds $1,200 monthly. The MIT Age Lab documented the retirement planning consequence with language that every financial planner servicing the 50-plus demographic should have memorized. Social Security retirement benefits of Americans ages 65 and older experienced a 500% increase in offsets over the last decade. 500%. The mechanism was a rarely invoked enforcement tool in 2010. It is now a systematic feature of the retirement income landscape for a growing population of retirees. The fourth stage is the double destruction phase. This is the stage that is unique to 2026 and that has no precedent in prior analyses of the student loan and retirement intersection. The double destruction phase occurs when the Social Security benefit being offset is itself on a path to being cut by 24 to 28% through the automatic reduction that occurs when the OASI trust fund is exhausted. The CBO projected in February 2026 that the OASI trust fund would be exhausted in the fourth quarter of 2032, approximately 6 years from now. When the trust fund is exhausted, benefits are automatically reduced to whatever level the ongoing payroll tax revenue can fund, which the CBO projected at approximately 76 to 77% of scheduled benefits. For the retiree already receiving $1,800 in scheduled benefits and having $270 offset for student loans, the net check after the insolvency cut and the continued offset is calculated as follows. Scheduled benefit of $1,800 multiplied by 76% equals $1,368, minus $270 in student loan offset, minus $202.90 in Medicare Part B premium. Net monthly income, approximately $895. The federal poverty line for a single individual over 65 in 2026 is approximately $15,000 annually, or approximately $1,250 per month. The double destruction phase leaves the affected retiree at approximately 72% of the federal poverty line from their Social Security benefit alone. The student loan that was supposed to finance an education that would produce a career that would generate income for retirement has, through the compound interest mechanism, the non-dischargeability statute, the no statute of limitations, collection authority, and the convergence with Social Security trust fund insolvency, produced instead a retirement income below the federal poverty line. Now apply the 3 historical case studies that prove each of the 3 elements of this destruction mechanism has documented precedent producing the permanent retirement security impairment that the current data projects. Case study. 1. The 1990s government debt offset expansion and the fixed income destruction pattern. When Congress expanded the Treasury Offset Program in the 1990s to include more categories of federal payments that could be intercepted for debt collection, the Social Security Administration and the GAO both documented the specific consequence for retirees subject to offset. The retirees reduced discretionary spending first. They then reduced medical spending, skipping prescriptions and delaying doctor visits. They then reduced housing expenditure, accepting overcrowded conditions with family members, or downgrading to lower quality accommodations. The sequence, reduced discretion, then reduced health care, then reduced housing, is the documented pattern of what happens when a fixed income is reduced below the minimum required for dignified living. And the specific feature of the Social Security offset that makes it more severe than an equivalent reduction in a working income is the absence of any ability to compensate through increased earnings. The retiree cannot work a second shift to offset the garnishment. Case study. 2. The 2005 Bankruptcy Act and the College Student Loan Exclusion. The Bankruptcy Abuse Prevention and Consumer Protection Act of 2005 expanded the federal student loan non-dischargeability provision from federal student loans alone to include all student loans, including private loans, with very limited exceptions. Before 2005, private student loans could be discharged in bankruptcy after 7 years from the first payment. After 2005, they were permanently non-dischargeable except under the undue hardship standard. The GAO analyzed the consequences of that 2005 expansion in subsequent years and documented that older borrowers with student loans, particularly those carrying Parent Plus loans taken out for children who did not complete degrees or who did not achieve the income levels projected, became a growing cohort of financially trapped retirees with no legal pathway to eliminate the obligation. The MIT Age Lab research documented the specific retirement planning consequence of the non-dischargeability. For older borrowers, student loans are generally one of several financial constraints that can inform spending and saving decisions. For most, student loan payments are regarded as stunting overall retirement savings, while the minority regard the two separately. The compounding of non-dischargeability with retirement income offset produces the specific outcome where the retirement savings that were stunted during the working years are then inadequate in retirement, and the Social Security benefit that was supposed to supplement those savings is partially redirected to the loan that stunted the savings in the first place. Case study. 3. The Japan lost decade and fixed income borrower destruction. Japan's deflationary decade produced a population of older borrowers in a specific financial trap that directly parallels the current U.S. situation for a different reason. Japanese retirees who had borrowed at variable rates during the bubble period of the late 1980s discovered in the 1990s that their fixed pension incomes were insufficient to service debts that had been manageable on working incomes. The Japanese government did not have a direct equivalent of the Social Security offset mechanism, but the practical consequence for retirees with fixed incomes and non-dischargeable debts was the same. The debt consumed the income that retirement required. The healthcare costs that accumulated because income was insufficient for adequate preventive care compounded the problem. The Japanese Ministry of Health, Labor and Welfare documented a persistent increase in elderly poverty rates throughout the 1990s and 2000s that was specifically linked to the combination of asset price deflation and fixed income debt service requirements. The lesson from Japan for the current U.S. situation is the compounding effect of deflation in asset prices simultaneously with fixed debt obligations. The Federal Reserve's 2026 severely adverse stress test scenario documented in the deflationary bust script projected a 30 to 39% decline in housing and commercial real estate prices. For the older borrower, whose retirement plan included using home equity as a final financial resource, a 30% decline in housing values combined with a student loan that cannot be discharged, an ongoing Social Security offset, and a Social Security benefit heading toward a 24% cut in 2032 is the compound financial destruction that Japan documented and that the American data is projecting. Apply the 3 case studies to the specific current data from May 2026. The January 16th, 2026. Department of Education announcement of a temporary delay in student loan collections for defaulted borrowers was published in the context of the Federal Reserve of New York's Q1 2026 data showing 6 million student loan borrowers transferred to the default resolution group in that quarter alone. That 6 million transfer is the largest single quarter movement into active enforcement status in the federal student loan program's history. The January 16th pause did not reverse those transfers. It paused the activation of the collection tools, specifically the Treasury offset, wage garnishment, and tax refund seizure, that the default resolution group transfer would normally trigger. The language of the pause documentation is explicit on its temporary nature. The student loan borrowers assistance organization documented the operative phrase on January 16th, 2026. We don't know how long the pause will last. If your loans are in default when the delay ends, you could face serious consequences. The government can take these steps without going to court, and there is no statute of limitations to collect this debt. That language is not a mischaracterization or a worst-case framing. It is the official description of the legal authority the government has over defaulted federal student loans. The pause is a delay. The authority persists. The 6 million borrowers transferred to the default resolution group remain in that status during the pause. The interest on their loans continues to accrue. When the pause ends, the offset activation requires no new judicial process, no new determination of ability to pay, and no new notice period beyond the 65 days required for the borrower to request a review after receiving the initial offset notice. The CFPB found that only 11% of student loan borrowers ages 50 to 59 facing forced collections successfully rehabilitated their loans. Only 5% of borrowers over 75 succeeded. The rehabilitation success rate falls precisely as the borrower's age increases, which is the inversion of what would be expected if the rehabilitation program were functioning as a practical pathway to exit for all borrowers. For the oldest borrowers, the ones for whom the Social Security offset is most financially destructive because they have no remaining income-generating years, the program designed to exit the offset has a 5% success rate. The 90,000 borrowers ages 81 and older with average balances of $29,000 each are the documented endpoint of the mechanism. They are subject to Social Security offset indefinitely. They cannot discharge the debt. There is no limitation period. The rehabilitation success rate is 5%. Their monthly Social Security benefit is subject to up to 15% withholding. The floor of $750 is 40% less in real purchasing power than when it was established. And their scheduled Social Security benefit is on a path to a 24 to 28% cut in 2032. Here are the 3 things every American over 50 with any federal student loan balance, whether in default, in income-based repayment, or current on payments, should understand about the retirement risk this creates in the 2026 environment. The first is the negative amortization calculation. For any borrower whose monthly income-based repayment payment is less than the monthly interest accruing on their balance, the loan balance is growing rather than declining. The calculation is straightforward. Multiply the outstanding balance by the interest rate and divide by 12. That is the monthly interest accrual. If the monthly payment required under the income-based plan is less than that amount, the difference is being added to the balance. A $25,000 balance at 7% interest accrues approximately $146 per month. An income-based payment of $75 per month means the balance grows by approximately $71 per month. In 1 year, the balance has grown by approximately $852 despite every required payment having been made. In 10 years, the balance has grown by approximately $10,000. That is the mechanism the GAO documented when it found older borrowers whose balances increased during offset. The second is the Parent Plus loan-specific risk. Parent Plus loans are federal loans taken out by parents to finance a dependent child's undergraduate education. They carry higher interest rates than direct student loans, currently above 8% for loans issued in recent years. They are in the parent's name, not the child's. When the parent retires, the Parent Plus loan is their debt, not the child's. If the child does not take over the payments or cannot, the parent's Social Security benefit is subject to the offset upon default. The CFPB specifically flagged Parent Plus loans. If you took out Parent Plus loans, the same rules apply to your retirement benefits. The parent who borrowed $50,000 in Plus loans in 2015 to send a child to college is carrying a balance that at 8.5% interest accrues approximately $354 in monthly interest. If that parent is now 62 and their income does not support full payments, the income-based repayment plan payment may be less than the monthly interest accrual. The balance grows. The retirement approaches. The Social Security benefit becomes the collection target. The third is the rehabilitation pathway and its specific time requirement. Loan rehabilitation requires 9 voluntary, reasonable, and affordable payments within 10 months. Upon successful completion, the default status is removed from the credit report and the Social Security offset ceases. The monthly rehabilitation payment for a Social Security recipient may be as low as $10 per month, specifically if the borrower's income is below 150% of the federal poverty line under the reasonable and affordable standard. The 9-month rehabilitation period is the only pathway that removes the default status from the credit report, which distinguishes it from consolidation, which also ends the offset but does not rehabilitate the credit history. For the borrower who knows about this option and acts on it during the current January 16, 2026 pause, the window to prevent the offset resumption is open. For the borrower who does not know or who has cognitive limitations documented by the CFPB as affecting 22% of Social Security beneficiaries with student loans, or who received the pause announcement but did not understand it as the specific urgency it represents, the pause ends without their having acted, and the enforcement machinery resumes. The 500% increase in Social Security offsets over the last decade documented by the MIT Age Lab was the trajectory before the two. 6 million Q1 2026 transfers to the default resolution group. Before the January 16, 2026 pause, that is temporary by its own explicit language. Before the Social Security Trust Fund insolvency, that will cut the benefit being offset by 24 to 28% in 2032. And before the 90,000 Americans who are already 81 years old and carrying $29,000 balances, each have had another year of interest, accrual added to their obligation. Subscribe right now, because the next video in this series documents the FDIC Q1 2026 banking profile expected at the end of May, the FOMC minutes from approximately May 20th that explain the first 4 dissenter votes since 1992, and the tick data from May 18th, that is the first official measurement of foreign treasury demand during the Iran war's worst month, 3 data releases in 2 weeks that together form the most complete picture available of whether the financial system has the capacity to absorb the convergence of all the crises documented in this series, including the student loan retirement destruction that is operating on the people who are simultaneously the most politically active voters, the most dependent on Social Security, and the least equipped by the financial planning industry to manage a threat they were never told existed. No statute of limitations, no bankruptcy discharge, 15% of every Social Security check, for as long as the balance exists. And for some of them, the balance is growing. That is not a student loan problem. It is a retirement security emergency. And the January 16, 2026 temporary pause is not a solution. It is a delay.